Welcome back to the show. So the currency wars are back, and some economists have predicted that the euro will fall to 115 against the dollar by the end of 2015. To help break all of this down, I was joined by noted economist and author Jim Rickards. In this segment, I asked him for his prediction for the euro. Here's what he had to say.
Well, I have a lot of respect for David Wessel, but what he said was that we're on the verge of a currency war. That was an exact quote from his article. We've been in a currency war since 2010. The point is, Aaron, it's the same currency war. Now, it's like a real war. You know, real wars are not all fighting all the time. You have big battles, and you have quiet periods, then another battle. This currency war started in 2010, involving Brazil, the United States, China. We saw the Japanese yen go down precipitously beginning in December 2012 with Abenomics, and there was another quiet period. Now the euro is going down a little bit. But here's the problem today. Right now, the United States is bearing the entire weight of structural adjustment around the world. China is manipulating the yen lower, the yuan lower, rather. The yen is crashing. Sterling's going down because of the Scotland fears. The euro is going down because of Draghi's policies and negative interest rates. So the dollar is by far the strongest currency in the world. But the United States cannot bear that. The United States economy is in terrible shape. We're seeing deflation, not disinflation, but deflation. All this talk about raising rates in 2015, people debate, you know, March versus June. I think that's not even close to being on the table. I think that they will probably go to QE4. I mean, they'll finish the taper, but we have a much more dovish Federal Open Market Committee beginning in January. Some of the presidents come off, the hawks come off, the doves come on. There are vacancies that the president's filled. You have a very dovish committee. I could see them going to QE4, certainly not raising rates. The U.S. has got to bring the dollar down. The U.S. is desperate for inflation. We're not getting it. We're seeing deflation. When rates are zero and you want inflation, the easiest way to get it is to cheapen your currency, raise the price of imports, and that's what the U.S. will do. So right now, yeah, it looks like king dollar all over again, but that can't last because the U.S. is going to be the one who needs the help.
Now, Jim, Ed Harrison noted just yesterday that every developed economy that has seen house prices fall in nominal terms nationally has also seen economic crisis or depression, except for France. So if the ECB is doing QE, shouldn't it focus on French and Italian mortgages?
Well, the problem with the ECB is they've got a European Monetary Zone-wide mandate. They've got a Eurozone mandate. So yes, and this has been the problem all along, you have different fiscal policies, different structural policies, but a single monetary policy. Certainly Greece would have liked a lot of these in 2011. They didn't get it. They got, you know, basically a very strong currency. The euro got stronger throughout 2012 and 2013. So I don't really, the ECB has to look at inflation, deflation, and price stability on a Eurozone basis, looking at the entire Eurozone. So you can have these individual pockets. So I don't think they're going to ride to the rescue of France. Now, they will buy, they've indicated they will buy mortgage-backed securities to provide some liquidity, but it's not really targeted at France. I mean, France will be included along with Spain. What they really want to do is get the securitization market going to free up bank balance sheets so the banks can hopefully do some more lending. Not clear that that's going to work, by the way.
Jim, the Fed is tightening, and many expect it to raise rates. And so far, it looks like the U.S. economy can withstand the hike. So where is the U.S. headed in 2015?
The U.S. economy is in terrible shape. I mean, look at employment. You know, everyone, all the, you know, the sort of commentators said this August data was junk and it was an outlier. That's nonsense. Employment from June to July to August, you look at those three employment reports, it went down significantly every month. That's not an outlier. That's a trend. And historically, September has been weaker than August, so we might expect another weak employment report for September. Again, the inflation data is coming in negative. This isn't disinflation. This is deflation. So you look at the world as it is, not through rose-colored glasses, but job creation is slowing down. Labor force participation is declining. And we have price deflation. That's the exact opposite of what the Fed wants. The Fed wants labor force participation to be reduced. They want more jobs to be created. They want more inflation. They're not getting any of that. So the Fed's not going to raise rates in 2015. I doubt they'll raise rates in 2016. Let's wait and see. But I think QE4 in, you know, maybe March or April of 2015 is as much, that's a stronger possibility than raising rates. The U.S. economy is extremely weak.
Now, it seems like the currency wars are a constraint on the Fed. So how can the Fed get off zero when the ECB is doing QE and the Japanese are too?
Well, you do more QE. I mean, by the way, I don't, you know, I talk about these policies. I don't think they're good ideas. I said the Fed should have raised rates in 2009, so I'm kind of 5 years out of step there. So I want to distinguish between what I think they should do and what they're actually doing. But using Yellen's words, her speeches, her models, and her way of looking at things, when she takes the dual mandate seriously and she wants more job creation, when in fact job creation is slowing down, there's enormous slack in the labor markets. There's a whole debate about whether that slack is structural or cyclical, but she follows economists who would argue that it's cyclical. That means she thinks monetary policy can do something about it, and she takes it seriously. She's waiting for a more dovish FOMC. What she's got to do is get to January. The hawks are going off the board. The doves are coming on the board from the regional reserve bank presidents, and there are some vacancies that the president's filling. I think you'll see Lael Brainerd and Stan Fisher line up behind Yellen. Yellen's hands were tied by Bernanke, by the vacancies, by the overweight of the hawkish Federal Reserve Bank presidents. That's all going to change in January. I think she'll be her own woman, so to speak. She'll be a little bit free of the Bernanke legacy. She's a super dove. So's Dudley. So's Brainerd. So are the other, some of the regional Reserve Bank presidents coming on the board. So I think you could see more increased asset purchases. The Fed will call it QE3 because QE3 was open-ended. They said we could do more, we could do less, depending on the data. Data's coming a week. I see them increasing asset purchases. I'll call it QE4 next year. But the U.S. economy is in terrible shape. She just needs to get some allies on the FOMC, and she'll have them in January.
That was author and economist Jim Rickards. Time now for today's big deal.